going. First webinar that we're doing with Davis Advisors here at Lead Lag Media. Do me a favor, folks. If you happen to be an advisor and you are in an office where there are other advisors, let them know that this is happening. Davis Advisors is a hell of a firm. They've been around for a while. I know a lot of advisors might be familiar with their sort of older flagship product, the New York Venture, the Venture Fund, right, as I recall. So we've got Dodd Kittsley here, who I've known since 2020. We're going to be talking about markets, outlook for next year, what Davis Advisors sees. If you are here for the CE credits from the CFP, for the CFP board, I will email you after this webinar. Get your information, submit it to the CFP board, just state at the end of the presentation. And if you do have questions, put in the Q&A, put in the chat. We'll try and address it towards the end. Dodd wants to make this more of an informal presentation and discussion. So, feel free to interact with us here. So with all that said, my name is Michael Gaia. This webinar is sponsored by Davis Advisors. Let me hand it off to Mr. Dodd Kittsley, who's going to introduce himself, and we'll get right into what's going to happen next in markets.
Thanks so much. And I appreciate everyone tuning in your interest in our ETFs. We find that our suite of 4 ETFs are often, people aren't aware of them. And the irony is we were way ahead of this major trend in asset management, this major trend in the ETF industry of active ETFs. And we were really the first to launch active equity ETFs that were based on strategies that had existed in most cases for multiple decades. So tried and true investment discipline and research approach that has, a strong track record, great people at the helm with a very long tenure. And we launched our ETFs. It's going to be 9 years, believe it or not, come January 11th, which was a great day. So as the saying goes, I guess it's often better to be early than late. And we really feel like pioneers in the space and really grateful that the industry's really taken off. But the fact of the matter is most of people aware and familiar with Davis are traditional mutual fund users or SMA users. And we entered the mutual fund space back when there were not a lot of mutual funds. It was back in 1969. And our firm and our investment discipline has its roots that go back to the 1940s. We're privately owned. 3 generations of the Davis family. The grandfather, Shelby Cullum Davis, essentially made a fortune investing $100,000 that he compounded over his lifetime to be over 800 million. And those investments were exclusively in stocks and primarily financial stocks. And very few people have built that kind of wealth exclusively through investing in the stock market. So we are a learning-based culture. We certainly, I think, get better as time progresses. We debrief on the mistakes. We realize that you got to do lessons learned sometimes when you make mistakes, and it only makes you stronger when you become aware and accountable for where the wheels might have fallen off the cart in some instances. And we all make mistakes. But certainly trying to minimize those in the pursuit of compounding wealth over time, which is our goal. The second Davis was also named Shelby MC Davis, and Shelby started our firm in 1969 off the heels of a very successful institutional investor career working with pensions, endowments, other institutions, large institutions. And he really launched the firm in partnership with advisors. And he was a little reluctant at first. And I share this story because I think it's a neat parallel to why we got into ETFs. But he, as an institutional investor, was approached in the late 60s, and people said, well, why don't you do what you do, but deliver it to a broader group through these things called mutual funds? And his knee-jerk reaction was, well, we don't do that. We're an institutional shop. Well, thankfully, he thought about it, and our firm was formed in 69. And I think the parallel exists today where the third generation of Davis is Chris Davis, who's our chairman. He's our portfolio manager for our large cap strategy and our financial strategy, co-portfolio manager in both those strategies, and really the culture carrier of our firm. And Chris hired me 9 years ago to help launch our ETFs. And I think the rest is history. But I think the fact still remains that our ETFs are largely, not on people's radar screens. And my goal today is to give you information so you are aware and to be able to follow up with any specific questions you have if we don't get to it during the call. Michael asked me to put together a presentation, so I guess I'll share my screen here with you, but I'm going to loosely follow it. I want to just share some things that really can get you more familiar with our process, our people, and the value that we have to offer in the marketplace today. Again, this is my direct number, my email, and I urge people not to hesitate if we don't cover the topics or the questions that are most important to you. So let me just start with a little bit more, give you the history of a little bit of the history of Davis Advisors. And we do have a very rich history, being pioneers in mutual funds, being pioneers in SMAs in the 90s, and thankfully today, ETFs. But what hasn't changed really is our investment discipline. And to give a little background there, we are high conviction managers, long only equities, generally large cap stocks. And we're deeply rooted in the research process, where we simply try to answer two questions as pretty high bars of what we want to include in the portfolio. So not based on any indexes. You could say that we're benchmark agnostic, if you will, where we won't own entire sectors at a time if we think they're unfavorable. It's really a best ideas portfolio of stocks, essentially. So let me go to two just to kind of tie with a bow the different products we offer. My heart is with ETFs. I've been doing ETFs for almost 30 years now, which is embarrassing to say age-wise, but it's been truly an honor to be somebody that has been educating, promoting, and really sharing insights on a product that's added so much value to the marketplace today. And I think the best days are still ahead. It's just a better mousetrap. That being said, we do offer SMAs, mutual funds, and ETFs. And the reason we got into the ETF business in the first place really was to provide choice. Advisors came to Chris Davis, came to the folks working at Davis before I was here, and essentially, asked the question of, why don't you offer your strategies in an ETF format? So that was really the genesis of, thankfully, me being hired here, but also the products coming out. And the commonality between all of these, they're not carbon copies, they're not clones per se, but they are analogs is like what we like to call it. But they're essentially trying to provide the same type of exposure, whether your preference is to access through SMAs, mutual funds, or ETFs. And that's driven by the advisor. It's driven by the investor. And they're essentially, what their goals are. Obviously, in tax-sensitive accounts, ETFs make more sense. I'm partial to ETFs, so we'll leave it at that. But we simply got into the ETF business to provide exposures that we've been very successful in a deep expertise for nearly 60 years now. The ETFs will have less stocks in general because we do manage to make sure that the basket that we provide is very liquid, that large trades can occur, that spreads are relatively tight. In the 9 years we've been doing this, we haven't had a single complaint on execution. Standard rules apply, use limit orders. Don't buy at the market open or the close for obvious reasons, so that the trading community can really get a sense for what's in the portfolio and what its valuation is after the market opens. And there's often a lot of influx of trading near the close. So if you follow those rules, you're going to be in very well stead. The ETFs have got a strong track record of very little, if zero, capital gains in each and every year they've been around. So a strong, almost 9-year track record now there. So let me get back to kind of what do you get when you buy a Davis portfolio? And I really want to focus on our large cap strategy. That's the one that's been out the longest, really, since 1969. In these examples, I will often interchange the portfolio SMA, the fund, or the ETF. It's really more for compliance reasons, but you're going to get the same type of exposure regardless of the wrapper that you're using. So I'll backtrack. We are certainly research based, and the two questions we're really trying to answer is what businesses do we want to own, and the second is what do we want to pay for them. And I would say that if you were to characterize us in the value landscape, Davis is clearly in the relative value type of camp. We want to buy great businesses at fair prices. We don't want to buy fair businesses at great prices. So we're not picking up the cigar butts, the stocks that maybe are trading at a very low valuation, and rightfully so, because they're impaired businesses. What we're looking for is really the growth in value and the value in growth. So while we think we're clearly in the relative value, large cap value camp, many advisors, many investors use us for their core exposure. So what do we look for in a business? In this kind of sums up the characteristics that we're looking for. We're looking for businesses that are have competitive advantages that are sustainable, that are going to be compounding machines over time in their business. So we think about businesses very much like Berkshire Hathaway does, in that for every stock that we buy, we assume that, hey, we're going to buy the entire business. So we look at it that way. And I think taking a very long-term approach, because we are very long-term oriented and have relatively low turnover, we deeply research these companies that are going to be high quality, strong balance sheets, excellent management teams with a proven track record, fair executive compensation, strong cultures, and again, competitive moats, strong competitive moats that are sustainable over time. What you get from that, and we'll go into the holdings and the portfolios a little bit, but you're essentially getting again the growth in value and the value in growth. So it's not a traditional all low PE stocks with kind of not great earnings. It's certainly not a go-go growth where earnings estimates are kind of exaggerated and unsustainable over long periods of time. Our research team, average tenure has been nearly 15 to 20 years with the firm and being together. They hold themselves accountable to really be in the top decile of knowledge of any business that we buy. So we spent a lot of time with Google before its IPO. We didn't invest initially at the IPO, and that was a mistake we learned from. But it's one that is in our portfolios today. Not a traditional growth name, Alphabet, but it's one that we do see that the higher valuation in that stock is certainly justified, in our opinion, going out 3, 4, 5, even 10 years in a lot of instances. We'll own some very attractively valued stocks relative to the market too, with less growth, but still find that those businesses are sustainable, and maybe they're discounted a little bit too much to its price at the current time. So our average holding period is relatively long. We do true up positions, businesses that we really own, very much like a company buying back stock when they have serious conviction that, their business is, undervalued at the time. So, we are stewards, first and foremost. And I think another differentiator, I know I'm throwing a lot at you here, but I want to cover the bases so you really get a feel for who we are. We eat our own cooking. We are the largest shareholder. The firm is the Davis family and the foundations that we represent. About just under $3 billion of the 30 that we manage is firm, family, and employee money. So we truly do eat what we cook. And that's really unique, I think, in this industry where, we're going to make the right decisions because we're not managing money for our shareholders. We're managing money alongside our shareholders. And the fiduciary standard is one that we take very seriously. It's not to say that we're sometimes out of sync with the market, especially when the market gets a little long in the tooth, as it has, in our opinion, over the last say 10 to 15 years. It's been an abnormal period. I think everyone would agree with that, where there's been some major excesses in the marketplace. But we're going some significant transitions right now that we believe we're entering a period where fundamentals truly do matter. It's not just stocks that are great stories that everyone wants a piece of and get bid up so high that they all of a sudden become unattractive investments, yet still very desirable businesses to be in. And that's not something that we will ever invest in, and is often a trigger if a company becomes too highly valued to lighten up or exit the position. Which is a good problem to have, I suppose. So second question is, what are we going to pay for it? And I think I covered that pretty well. But happy to expand on that in Q&A, in terms of sell discipline, in terms of, valuations. But bottom line is we look at all the companies relative to each other. And what is the expected long-term IRR? So free cash flow is something really important to us, as well as a lot of the qualitative things that I don't think anyone could ever capture in a stock screen. We certainly do screen for the characteristics that I talked about, like high quality, moats, those sort of things. It is a sourcing and idea generation process, but it really ends there. And our guys are out on the road. Our guys and gals are out on the road, meeting with management teams, meeting with CEOs, competitors, customers, time and time again, to really get a great 360 view of every business that we're investing in on behalf of our shareholders. So from a top-down perspective, and this is the way I always viewed the world, being in the ETF business for so long that was largely active until relatively recently, at least materially. So if you were to really characterize what the output and what you're getting when you buy a Davis portfolio such as DUSA, you're getting a portfolio that is, again, best ideas of a highly rigorous investment discipline. So anywhere between 25 to, in this case, is the mutual fund, 43 stocks. So it's very selective. And we firmly believe that we've entered a period where rising tides is not going to, rise all the boats. And what you don't own is going to be just as important as what you do. And we can't say that for every time period we've been in, but over economic cycles, that certainly pays off, and I think has been one of our secret sauces. We call it time arbitrage, if you will. So in DUSA, again, like 26, 27 individual names, we often get the question, how do you weight these things? And we weight them by conviction. We generally won't let a position run up to over 10%. And when you see big weights, it's either highest conviction names is generally the reason, or a massive recent run up. And I would expect us to trim to right size a position to maintain very good diversification. We feel we provide that with 27 names in the ETF. And we certainly can go into our global strategy, can go into our international strategy. And a lot of folks ask, why do you have a financial strategy? And again, that's been the roots of the firm. I would argue that doing fundamental research on financial businesses is probably the hardest of any sector in the market. It's the most diverse sector in the market. But that's where our investment discipline really came from the grandfather. Chris has managed our financial fund for 35 or so years, very successfully. So we have a high degree of expertise in perspective from a long time in financials. Okay, so selective, we've kind of gone through that, and I'd say an emphasis on quality and competitive moats and sustainability of earnings growth balanced with valuation. The next one is we're undervalued. So relative to the market, if you define it as the S&P 500, and even relative to the Russell 1000 value, which is trading a little rich. It's gone down a little bit since we did this slide. It's just under 18 now. But so is DUSA, trading at 14.3 multiple as of the close yesterday. So very attractively valued. And I think this is really, really important in this environment, because the thing that we hear among the biggest concerns on the minds of investors is overvaluation in the market, the Mag 7, just overvaluing the U.S. equity market in general, and what's going to pop that bubble or create a sell-off. We feel very comfortable that in the event of a recession, in the event of a economic slowdown, and even a crisis, that we can emerge from that. We'll be defensive in the first place, but we'll also emerge from that even stronger. And that's part of every discussion in every investment consideration as well, is we assume that at some point during our holding period that we're going to go through an economic downturn, and we model for that. And that's why there's an emphasis so much on quality and strong balance sheets. We certainly don't want to have to go through that. Nobody does. But as one of the fun sayings, and I think it really rings true, of Shelby Cullum Davis was, you make most of your money in a bear market. You just don't realize it at the time. So we don't wish market turmoil on anyone in anyone's investments, but that's, I think, a time where true fundamental research and a disciplined approach, that's where you earn your stripes, not when everything's high flying and going well. And then I want to also underscore the last part of this slide, the attractive growth. We do look for companies that have above average earnings, but more important than that is the sustainability of the earnings. So again, we'll own some companies with higher earnings, but only if we feel confident that that's sustainable over long periods of time. It's interesting because in my past, quarterly earnings of businesses really meant everything. And here, it's not that it's unimportant, but what's more important is actually earnings on the sustainability at over long periods of time. So certainly an earnings report is important to us because it's a checkpoint along a long journey. Could raise red flags, could be a confirmation that, hey, we're getting this right. We're really, our assumptions about the businesses are playing out and the growth of the businesses. But we don't put too much emphasis on, did Alphabet make its earnings yesterday, or JP Morgan, or what have you. So, attractive growth, and in the result again is above average growth, even relative to the S&P 500, believe it or not. So, a portfolio that's trading at just over 14 times today, that has above average 5-year earnings growth rates. That is historic, but if you look at it on a forward basis, and there's biases there because it's based on analyst estimates, but we're above average in earnings growth. So it's kind of Goldilocks, where you're getting a little bit of everything. You're getting growth, but at the same time, some potentially defensive characteristics as well. All right. I didn't want to go too far on that. Anyway, again, sector breakdown here. I just really have this slide up here, not to emphasize as much about, hey, we're not really favorable in utilities or real estate right now. And certainly we can go into that on Q&A. And we, our biggest overweight is financials, not surprisingly, because we think we have a real edge there. I think the information technology bars are a bit misleading because of the classification of companies like Meta and Alphabet in the realignment there. So we still think of those as largely technology companies. But the real point here, and this does change over time, is that we are completely benchmark agnostic, and I think that's something that really makes Davis, DUSA, and our large cap portfolio so special and so unique, is that we're so different than anyone else. And it goes along with the saying of, you can't expect different results or extraordinary results if you're doing what everyone else is doing. And that leads me to, how are people using our portfolios? Well, because we're so unique, for investors that are benchmark sensitive, sometimes it makes them a little queasy because you will see a lot of tracking error. But we think tracking error is a beautiful thing, and tracking error needs to exist to justify an active expense ratio. So that's one thing that I think really differentiates the long-term outperformers over time. If you're going to benchmark hug, you've no business being an active manager in most cases. And the trade-off for an investor is S&P 500 at 3 basis points, or Russell 1000 at 8. So anyway, we don't want to belabor that, but a great thing that ETFs did was really let indexing be an option to inferior active management. And there's a lot of bad active out there. I was shocked when it came to Davis because I, again, came from the indexing side, but I really started to get religion and understand that there is a place, and I think everybody's portfolio for long-term investors, those that want to compound wealth over time, there's a place for active. A lot of folks are using us in conjunction with index-based products, with other managers. If you look at us relative to some of the very popular large cap ETFs that are active, like a Capital Group ETF, for example, very little overlap. So you're getting something very different that gives you a couple things. The opportunity to zig when the market zags, or have positions that are going to, I don't want to say offset, but offset risk a little bit, and yet be able to outperform over time if you're doing something different than the market in a very thoughtful, methodical way. And that's, again, something I think that you get in enormous amounts by investing in Davis ETFs and in funds. So I talked about active share, 86%. In our large cap portfolios, DUSA, this usually is pretty consistent across the board, because of our very nature of having a concentrated portfolio of, again, 25 to say 35 to 40 names, and really being very research driven. And for the names that we do have that overlap, the weightings are often very different because we don't think market cap or the size of a company really should define the opportunity. And essentially, don't get me wrong, I love indexing. I think there's a time and a place for it. But if you really take a step back and think about what is your strategy in a market cap weighted index, it's allocating more money to the companies that are bigger, but also allocating more money to the companies that have grown the most from a stock price perspective over time. And a more expensive company, a company that just went up, is when you're allocating a lot more to over time, and sometimes that strategy doesn't necessarily pay off or be really kind of risk intentional, if you will. So let me just move on here. Performance. This is a mutual fund. I wanted to show a long-term track record. We certainly take our lumps during a momentum-based market, but use that as an opportunity to really position the portfolio to have a strong performance. And we're in just that period right now where we're seeing so many transitions from rates going from nothing to be more normalized, and that is weeding out a lot of things and making fundamentals matter more. We're in a period where globalization has certainly slowed, almost stopped, and that's created things. And we're in a period where AI is something that is fundamentally changing not just technology, not just the chip makers, but every single business. And we all feel that. Maybe it's a statement of the obvious, but AI is something that in recent year has really become a fundamental question again when we're considering any line item, any business to add. How will it impact? Financials is a great example here, where we think scale certainly helps, where you can buy or build things through technology and AI. Gives some of the larger banks, for example, some competitive advantages. Capital One, I think, is a great example too of a company we own that maybe isn't top of mind for everyone, maybe more so now after the closing of the Discover merger. But Capital One, we view as a data science company. They didn't even have brick and mortar until recently, and they have over 1,000 AI patents. So they're very much leveraging technology and leveraging artificial intelligence to price risk. And to add some real, synergies in their business. They're still run by their founder, Rich Fairbank, and we're very impressed with his approach. And we tend to favor sometimes owner operators and founders because it really does encourage good corporate behavior in oversight. If we're talking ETFs in DUSA, the fund's almost $1 billion right now, about 900 million. And it shocks me because out of the 192 large cap value ETFs, the largest is about over 150 billion. So, 150 times the size. But DUSA's a very strong track record too. So out of the 192 large cap value ETFs, it's the 8th best performer on a 1-year basis. We're including active and passive here. It was the number 1 performer now over the past 3 years, and was in the top quartile over the last 5 years. So I guess our joke, and it really shouldn't be a joke, we should be crying instead of kidding around, but it's the ETF, the best ETF that no one's ever heard of. So we urge you to take a look. If what we do resonates with you, you need more details. Urge you to follow up with me and our team of representatives. We've got a very strong team of client service folks that have, I think, the longest tenure of any asset manager, both internals and externals. So we're here for you. We're not a fit for everybody, but would love to continue the conversation. And if there's a place in your portfolio for us, we'll do everything we can to make sure you have all the details in transparency into not only the portfolio, but also our thought process in each and every holding that we have. And in a time where things are uncertain, people are nervous, valuations are high, you can't put a price tag on really understanding the minds and the process of the people that are acting as fiduciary for you in the case of advisors, clients as well. I've got a lot more slides here. I know we're at like 36 minutes. There's some here, kind of describing the last really kind of challenging period coming out of the dot-com bubble and where we can shine. It was New York Venture Fund because the ETF hadn't launched until 2017. But we can kind of continue this conversation as a follow-up or in the Q&A period. And I do have a bunch of slides as well on how we think about AI and how that kind of fits within our decision-making and investment discipline, because it is kind of a new addition, even though we're true and tried in terms of asking those two basic questions that we try to answer in committing to really be in the top decile of knowledge of the businesses we own. We also are a learning-based culture and will evolve over time. So with that, Michael, I'm going to turn it back to you to moderate, ask questions. I'm around here and would love to hear what's on people's minds.
And by the way, folks, if you want to get access to the deck, just shoot me an email, respond to the Substack post I put out, and I'm sure Doc can get those to you. I see a couple questions. Ray, good to see you, by the way. Ray Scheimer here. His comment here, it seems like over a long time frame, years, the exposure to financials, while still high relative to indexes, is less than it used to be, now around 30 as compared to around 50% in the past.
Yep.
So long-term change or change to the opportunities that you're currently seeing?
Yeah, it's a great question. We often hear, people take a glance and they're like, well, you're always overweight financials. And they think we cover a little bit of that. We do think we have an edge and there's enough companies in there to select from to really feel like we've got some good ones in most market conditions. And financials are so misunderstood. But we have pared back pretty materially, even though it is our largest overweight still. That's been largely on valuation. We exited positions in like JP Morgan because it ran. It was such a great performer. We've lowered our weights and pared back in some of the big names. I mean, with 40, 50% runs. We always balance that question on a daily basis of, does the valuation justify the earnings growth that we're seeing? And in the case of financials, surprisingly, because they are largely viewed as either boring or part of the problem, not part of the solution. But they have been part of the solution since the global financial crisis in most instances. So, we pick our spots. People are like, well, with higher rates, that's going to be, sometimes beneficial, but with higher rates and pressure on credit and credit losses, why you're still high, that's not really driving it as much as valuation in the moves.
Question from Jay about the overlap between your venture and the financials fund.
Between the financial, it's largely everything you get in the financials fund. By and large, there are a few exceptions, and the beauty of ETFs is you can see this, right? The financials fund is a little bit more diverse, but it's going to rhyme pretty darn closely. So you certainly just download from our website. It's davisetfs.com, DFNL. Into USA and see that difference. But if we've got our top picks, the highest weights that are in the financial fund, most certainly will be in the USA or New York Venture.
And then a follow-on question from Jay. Thoughts on AI? Because no one ever talks about AI. So it is true. It's interesting.
Nobody does, right?
Yeah, right. But I think from your perspective, as a very serious active shop.
Yeah. Again, we look at a couple different ways, beyond the darlings, beyond the high flyers or the big names like NVIDIA. And don't get me wrong, we think NVIDIA is a wonderful business, but we think some of the baked in growth assumptions on its valuation are just not sustainable. I mean, historically, companies to be able to maintain margins and earnings growth that NVIDIA is having right now, in many of the other chip players and others, is we think a little bit risky and certainly a little bit long in the tooth in terms of assumptions. So we played a different way within technology, and I've got a few slides on this that Michael can send to you, or please ping me. I'll shoot you the deck as well. We've written a lot about this. Chris wrote about it a lot in his commentary that's on our website as well. But we like the picks and mortars a little bit. So Applied Materials has been a company that makes semiconductor manufacturing equipment and is going to benefit, but from the growth in the demand for AI, but isn't at quite that same kind of valuation. We started to scale into some energy companies. Again, we were completely out for a few years for the demand on energy, but we're picking our places there. Capital One, I mentioned, we think is a bit of an AI play, given all their patents and their leveraging of. Meta is another big one. So we have a whole host of these, and it's, Chris always says investing is the art of the specific, and it truly is. At least here it is. Meta, we think, is going to benefit tremendously because of their use of AI in terms of driving higher margins in their advertising, and it really, with the over 3 billion users and them collecting data on this worldwide. I mean, everyone thinks of Meta, Facebook, is being kind of a U.S. thing, and the U.S. is a smaller part of their overall business. So they've got a lot of growth opportunity there too, because of their user base and their ability to leverage AI to demand higher margins and more sustainable margins from an ad perspective.
We'll wrap it up with one more question. I think this is a interesting question because it is on most people's minds, because you talk about fundamentals and valuation. From Steven here, do you think that the Buffett indicator, US GDP versus market cap, is outdated due to many multinational corporations generating revenues overseas, or does it still point to overvaluation in the overall market? Now, very specific question, but I do think it's interesting to hit on, because to a lot of people, it looks like everything's overvalued, but it keeps staying overvalued and gets more overvalued. So is it really overvalued, or is the indicator broken, right? And it's like,
Yeah. I guess I'll answer a couple different ways. I mean, the easy way out is go on our website. We actually have the Buffett indicator in Chris's commentary. And we do think, that it's not outdated. It's not something we rely on, but we're not, investors in the overall market. Again, we see some unbelievable opportunities out there, but the market as a whole, just the way it's weighted and defined by the indexes, is very richly valued overall. And I think poses risk when some event happens, and the big events that move the market are the ones no one can predict, right? So another saying we have here is that you can't predict, and so much of our energy is spent trying to predict because people ask, but you just got to prepare, and that's what we do. And I think as evidenced of that, I mean, you can get DUSA, large cap, primarily large cap, U.S. equities at a, just over 14 multiple in this market that's trading really rich, even defined as the value market, and I think a lot of people cite S&P 500 as being so richly valued, but with the Russell 1 value trading at 17, 18, 19 times, it's bounced around a bit. That's pretty rich when you think about you're buying value stocks. And it's one of the reasons why we don't own utilities, because in a lot, another cautionary tale, and it's in the deck. I'm sorry we didn't have time to get at it. I get a little verbose sometimes, but dividend plays are perceived as defensive. And in many instances, these companies are pruning the furniture to pay the dividends, right? And it's just not sustainable over time. So look at the payout ratios, look at the specifics, but there was so much demand for income generating ETFs and funds that it's essentially, and stocks for that matter, you can't blame the structure, but it's bid up the valuations. So all of a sudden, these yields are not attractive. I mean, the Russell 1000 Value Index doesn't have a very attractive handle on its dividend yield. So I know I went a lot of directions there, but I guess the point I'll drive home is look, we got a lot of opinions. And we'll punt when it's a company or a business that we don't feel we have expertise in. But we do have a lot of opinions in surprising areas, like the heck's Davis, a value manager, talking about AI for. But I think that's our value add, right? Is to share your expertise in certain areas and share your perspective when it differs from many other managers that you're using or approaches or your own. And you only learn through discourse and understanding the other side to really make moves. So
I think that's a good place to wrap up this webinar. Appreciate those that attended. Again, if you want the deck, just shoot me an email. I will email you for the C credits for those that need that or want that afterwards. Special thanks to Dodd Kittsley, to Davis Advisors, and I'll see you all in the next webinar. Thank you, Dodd. Appreciate it.
Thanks, everyone. And Michael, I really appreciate this. It's an honor to be on your show. So appreciate it.
Thank you, everybody. Cheers.